Hey everybody, Tim Vigo here, and I got some special information for you. So, as many of you probably know, the real estate market has been going crazy, and even crazier with the Fed increasing their rate by 0.5% yesterday. So, that I know can cause some uncertainty, and you're going to see a lot of headlines out there that could be intimidating. But I'm here to share some news nationally that might help ease some of this pain. Now, this is just straight data. These are facts with some projections of what people predict the future will be, but it'll at least give you a better understanding of the market because the questions I get asked every day is, we're on the bubble. When are we going to go down? When is this going to correct? Blah, blah, blah. Well, it doesn't look like it anytime soon. So let me share these slides with you on the special housing market update for you. So first up, this is a quote from Len Kiefer, Deputy Chief Economist from Freddie Mac. Mortgage rates are likely to continue to move higher throughout the balance of 2022, which we knew that based off what the Fed's been saying. Although the pace of the rate increases will likely moderate because right now the Fed is moving aggressively. And a lot of that has to do with the inflation, because this is one way they can battle our high inflation rates. Much of the increase in rates in early 2022 is in anticipation of what will happen later this year, especially with the Federal Reserve's interest rate policy. So now it always brings up the fear of, well, what's going to happen? Well, just look at historically what has happened with interest rates rising. So these are a couple time frames, 6 of them over the last 30 years or so, with rate increases of over 1%. And as you can tell, the correlation in every single instance is housing prices still increased. So increase of the interest rates did not cause a decrease in home prices. So we've increased, and on average, it's about 8% over those time frames. So some as low as 2, some as high as 13. Now here comes the more interesting trend, which I could see why this would happen. So just take a quick look at the home sales. Home sales, though, have decreased. So we are going to see a little bit of a shortage in home sales, most likely because there's going to be some sellers that are going to be sitting on the fence and it's going to move them off the fence. I mean, look at this difference. The biggest ones in here, though, is the 14% and the 11%. Another thing to point out, look at some of these outliers in this data. So we had a 2.38% increase, which pushed us up to a final number of 9.2% for your interest rate in the early 90s. We don't see it going that high. The other outlier, 6.76% back in right around the time where we did have a housing bubble. We also don't see it necessarily going up to 6.76%, but only time will tell. But if you take those out of the equation, for the most part, home sales have either increased by 2% or decreased by 2% for the amount of homes that we've sold. Now, here's an interesting chart. And this is taking data from World War II with home price appreciation. As you can tell, we're beelining it straight up. So the numbers are increasing. We had a little hiccup here, which this was the crisis of 2008, where we were a bubble and the bubble popped. But since then, I mean, we've been slowly climbing back up. This, I think, is even more telltale. So in the red, you got the product risk and then the borrower risk. So the risky products that caused the bubble have pretty much disappeared. So we don't have many risky loan packages out there. That's a good thing. That's why we're not in a bubble, because of tighter regulations on the lending industry. So, and even the borrower's risk has decreased a bit more because the housing market is pretty stable. Now, this one is mortgage payments based off cash out refinances, which, as you can tell, look back around the bubble that we had in 2008. People would do a cash out refinance, go on trips, do whatever they want, and they literally increased their monthly payments by $4,000. We are not seeing that right now. I mean, in fact, in the last couple of years, the increase was only $66.34. So that's not a bad thing. Now, the national loan to value in Q4 2021 was 30.8%. So basically, everyone had at least 30.8% equity on there based off their national average. The lowest in over 3 decades, still a lot. In inflation adjusted terms, homeowners in Q4 2021 had an average of $307,000 in equity, a historic high. Now, here's some forecasts going forward. And the average of all the forecasts is showing about 9% increase for this year, 2022, which we are seeing homes increase at a rapid pace. But going through them all, knowing interest rates are going to go up, I mean, it's not a shocker. The Fed has said they're going to go up multiple times this year. We still see high projections for home values. Now, here's some future ones, January over January forecasted. So in 2022, we had 9%, but it's slowly slowing down to about 4 to 3% year over year. However, from 2022 to 2027, if you own a home, there's a great chance your home's value is going to increase $96,342 in a 5-year span. That's pretty good. So just some data to share with you. I know you're going to see headlines about, is this the end of the housing crashes? Oh no, homes values going up, but it's still a great time to buy. Interest rates are still low compared to other time frames in our history. So if you want to discuss a little bit further about what you need to do to sell your home, how you can sell your home and not have to worry about buying a home, or if you're looking to buy your home so you can tap in on some of this growth equity in the next 5 years, give me a call. Look forward to hearing from y'all. Bye.